How would you describe the year from a performance perspective?
Look, at the end of the day, we've been in a very strong bull market. The investment returns have been above 20% in the last 12 months. Our returns have been in line or slightly better than the market returns, but these returns in the last year are well above our long-term investment objectives of 9% per annum. And actually, if we went over 5 years, our returns have been 19% per annum, which is about in line with markets, but well above it. So very, very bull market conditions we've had. How do we feel about that? We're actually very, very happy. Actually, they're probably in excess of the returns I would expect, because we're running a strategy with a capital preservation bias. We've been running cash in the strategy, averaging between 10 and 15% during the last 12 months, and we inherently run a strategy with a much lower underlying inherent risk than the markets. And the markets have been incredibly momentum driven in the last 12 months. To actually keep up with those markets but expose our clients to less risk to what's actually been going on, I'm feeling not complacent but fairly happy at the end of the year. It's a very difficult market for strategies like ourselves not to reach for risk, and we don't believe we have reached for risk. We've kept running cash in the strategy. We've kept running a risk ratio slightly below a ratio that we would run. So there's some caution in what we're doing here as well, and I think that's very prudent. But you know, I don't think anyone can complain about 20% plus returns in super high quality companies when we're running some cash and 19% per annum. You know, that's above our long-term expectations.
Hamish, you talked about 19% over the last 5 years being in line with market, but you've done that with much lower levels of risk. Can you define how you measure that risk?
Yeah, well, how we define that, obviously we have something called a combined risk ratio that brings in volatility and brings in drawdown risk into that. And we run a maximum ratio at 80% of the market's ratios there. So we're inherently running less risk, but we actually measure the outcomes over time. We measure something called the drawdown ratio. So what we're trying to measure there is when markets go down. So we look at any quarter where a market's gone down, and does our strategy go down less than the market? As in, are we exposing to less risk than when the markets go down? And actually over the last 5 years, in every quarter where the market has gone down, we have gone down materially less in every circumstance. There hasn't been a lot of those where it's been because we've been a bull market, but every time there's been any evidence of a down market quarter where the markets may have been negative in the last 5 years, every time we've had materially better outcomes. It's hard for people to see it that much when you've just had these consistent bull markets, 19% per annum for 5 years. But we do measure that. It is very important to us about the amount of risk we run, and capital preservation is something that runs in our blood here at Magellan.
Thanks, Hamish. I want to now turn to the tech sector. Much has been said around the run on tech stocks over the last 12 months or so, with many believing we could be in a tech bubble. Can I get your views on that, and perhaps in light of the stocks that we own in the portfolio?
Yeah, well, first of all, I would say is you can't just look like the share prices have gone up 70% and come up with the view that they are necessarily overvalued. Yeah, the technology stocks we've owned have had terrific runs in the last 18 months. But I would point out that in 2014 we invested in Microsoft that we still own today. We bought a large position in Microsoft at $28 a share. After it went up 70%, you know, it was in the mid $40 a share. If you use that test, it was up 70%, it was suddenly in a bubble and was expensive. We would have made the wrong decision. Microsoft today is over $80 a share, yet the 70% test, we would have sold it in the 40s. It was materially undervalued even after it had gone up 70%. And we would say that Microsoft is still modestly undervalued under our base case analysis here, and on the upside analysis more materially undervalued still, yet it's up 3 to 4-fold since we bought it back in 2014. So yes, we've seen some strong price appreciation in Apple that we bought, but Apple's trading on next year's earnings at 14 times earnings, a material discount to the market. And we are we're very optimistic around the long-term prospects of Apple, and still regard it as being very materially undervalued, notwithstanding it's up probably around 60% from when we bought it. If you look, two of the other technology stocks we own, which would be Facebook and Alphabet, Alphabet's trading at around 23 times next year's earnings, and that isn't adjusting the earnings for the $100 billion of cash they hold. It's not adjusting their earnings for the losses they have in what's called other bets, things like driverless cars that they own. If you adjust it for that, it's trading materially less than 23, actually less than 20 times next year's earnings, and it's growing its revenue at above 20% per annum at the moment. We don't think that's a stretch valuation at all, and Facebook's trading at 25 to 26 times next year's earnings. It's a higher multiple, but Facebook is growing it at 40 to 50% a year at the moment, and we still think they've got very, very material penetration to still take of the global advertising world with deep competitive advantages. So no, we don't see a huge bubble, notwithstanding prices have gone up in that space, but there are bubbles around. I think Bitcoin is absolutely frightening in a speculative bubble at the moment. And the problem is the more it goes up, there's this huge fear of missing out, and more people get in. It's got limited supply, and when more and more people get involved in a mania like that, you see this explosive growth. And now people talking about they wish they'd been smarter to buy at $300. It's now $20,000 a Bitcoin. It's doubled in the last 6 months or less, and now people are piling into that. I think there are some technology firms that are listed, big technology companies. I don't really want to call them out. That I think there's a huge amount of speculation in their share prices at the moment. There's some unlisted technology firms where I hear about what the private traded values of these companies are compared to my perception of the competitive advantages of those businesses, and some of them some of that looks like a bubble. So I don't want to say there are no bubbles around. Clearly we've had a 5-year bull market here, but we're very, very focused on where we see value here, and we see still a lot of value in some of the technology companies we're investing in, notwithstanding they may be up 40 to 80% in the last 12 months.
Changing pace a bit, what about the impending US tax cuts? What are the implications for our portfolio?
Well, last year I spoke to people about, there's a lot of noise with the Trump administration, but I said if you dig beneath the surface, there are some policies that could be beneficial. Stripping back regulation, taxation reform was another area that the Republicans may get behind Trump to do something here. The odds are looking pretty strong. We could get a material tax cut to the corporate tax rate and a change to global taxation. We've obviously got big multinational firms with a lot of cash sitting outside America. So a reform to actually enable them to use that cash at a very competitive tax rate would be very beneficial for those large multinational firms like Apple and Alphabet and Microsoft and Oracle and others we may own. We own some US domestic businesses, and a cut in the tax rate, I could go to Lowe's or Wells Fargo and businesses like that, where a cut in the tax rate would obviously be very beneficial to our portfolio. And our portfolio would be skewed to that sort of US taxation risk at present. So we're not feeling uncomfortable. Whether these tax cuts pay for themselves or not is a different question. But from an investment perspective, we could be nothing but positive if those tax cuts went through.
And finally, Hamish, thinking about 2018, what do you think are the key issues that we should be focusing on?
Yeah, I don't want to beat on the same drum, and I may have said this last year. I really think the big story of 2018 is what actually happens with the central banks and interest rates. We still have the central banks buying at around $1.5 trillion worth of assets at the moment that are incredibly supportive for these very low interest rates. We've had 8 years of quantitative easing that's happened in the world that has distorted long-term interest rates. We now have proposals of a 12-month cut or a selling by the US Federal Reserve. We've got a halving in the quantitative easing program that's coming in January by the ECB. They are very material in the overall. We're probably going to take in 12 months' time, the level of support from $1.5 trillion of buying to around $500 billion of buying. So $1 trillion of demand is going to come out of the bond markets. I would argue that is relatively material and will probably shift interest rates, assuming it happens. The stuff that would cause it not to happen would be geopolitical risks in the world. So we're watching those. Probably the most important one, I would say, what's going on with North Korea at the moment. If we truly have a military confrontation in some form, the central banks are probably not going to carry through with their plans. We've got some trade issues between in the NAFTA partners, the United States and Canada and Mexico, but very importantly, the relationship between China and the United States, I think, is a critical piece of the puzzle here. We don't think it's very high probability we're going to get very adverse outcomes, but they're certainly foreseeable. So, and that could throw off the rising interest rate scenario. But in terms of what could really affect markets, we really think it's those geopolitical risks and the central bank's intended actions on their quantitative easing programs.
Thanks, Hamish.
A pleasure, Burjo.